Hey everyone, welcome to the KE Report and a daily editorial. We are chatting with Marc Chandler, managing partner at Bannockburn, Global ForEx, also editor of the Mark II Market website. Now, Mark, with you, we always like to look at what's happening in the currency markets, and one of the key drivers behind currency markets, actually two key drivers, one being central bank policies and another more recent one being Trump's tariffs. Those continue to move the currency markets, less so even the broad averages, though. Let's start off with central bank meetings. This week was a busy week. Last week was a busy week. We didn't have a chance to touch base with you last week, but overall, it still seems like much of the world, global central banks are continuing to lower rates. The Fed is on pause right now, but it does look like a lot of other central banks are starting to consider a pause in the near term. Mark, what was noteworthy over the last couple of weeks in your eyes for the central bank meetings?
Sure. So really beginning a week ago, that'd be January 24th, the Bank of Japan, contrary to the other major central banks, hiked rates 25 basis points, lifting their target rate to 50 basis points. This was well telegraphed. The market had it fully expected. I think that if anything, the central bank was a little bit more hawkish, and they basically are continuing though with this, like the party line, if you will, that as the economy evolves as they expect, that the BOJ is prepared to hike rates further. The market's looking for another hike later this year, the second half, and for the peak to be about 1%. But the driver for the yen tends not to be so much Japanese policy unless it's right around that event itself, a couple of days before it, or like in July, last July, when it was a surprise. Usually, if I had to find one variable that I think tracks the exchange rate, it would be the 10-year US yield. And you really see that in this past few days too, when the U.S. yield, or the 10-year, finding some support around the 450 level, and that is the low for the month. And dollar yen also recorded the lows for the month as the U.S. 10-year yield dipped below that 450 level. Now that we're up a little bit more, dollar yen looks a bit better bid. A couple other central banks of note, as you mentioned, the Federal Reserve is on hold. If anything, the Fed sounded a little bit more hawkish, and not hawkish in the sense of raising rates, but in the sense of recognizing the strength of the economy, that inflation is still relatively elevated, and that unlike the call from the White House to cut rates immediately, the Federal Reserve showed patience. And by patience, the market believes that the Federal Reserve will not will not cut rates until towards the middle of the year. And Powell basically indicated that that the Federal Reserve is still in that mode, saying that policy is still, quote, meaningfully restrictive, and that he would expect that as inflation falls towards its target, the central bank will be able to cut rates. The other central bank that was in the news was the Bank of Canada. They delivered a 25 basis point cut, as most people expected. They had indicated that they'd slow down after cutting rates by 100 basis points at the previous two meetings. Bank of Canada, like you said, other countries besides the Fed looks like they might be on pause. And I would say that if the U.S. has not put tariffs on Canada, it's probable that the Bank of Canada also pauses, which is to say that they do not hike rates at their next meeting. Excuse me, they do not cut rates. I get this confused. They do not cut rates at the next meeting, which is March 12th. And right now, the latest is that the U.S. tariffs won't go into effect until March 1st. So it does leave some of this variability here. If the U.S. has not put on the tariffs, I think that the Bank of Canada would hold, not cut rates until maybe the June meeting, though there is that April meeting that's always possible. Canada did report a weaker than expected November GDP, but the Bank of Canada made it seem as if their sort of early data suggests the economy bounces back in December. As we look ahead to next week, it's notable that the Bank of England meets, and the Bank of England had cut rates twice last year, and the market is primed for them to cut rates 25 basis points in the coming week. The ECB, I should say, just rounding up Europe, the ECB cut rates last week 25 basis points. And even though they didn't commit to future rate cuts, the market is very convinced that they're going to go again when they meet in March, another 25 basis points, with a small leaning towards 50 basis point cut. I don't favor a 50 basis point cut. I think that as they come to given how aggressive they've been, I think 25 basis point moves is the most likely scenario. For another cut, and probably even one after that before we get to the middle of the year is likely.
Well, Mark, when you look at things through the lens of the currency markets, at all these different central bank meetings where Japan has actually hiked and actually doubled its interest rate, but then when you look at things like the ECB, Canada, and even the expectations around the Bank of England cutting a little bit more aggressively than the Fed, how has that played into the currency markets? And is this need for many countries to now pause and regroup before all these potential coming tariffs? How are those affecting the currency markets?
Sure. So I think, the amazing thing is the dollar had an incredible run in the fourth quarter, one of the strongest quarters in a couple of decades. Think about what the dollar index did. It went from roughly par 100 at the end of September, just as the Federal Reserve was cutting interest rates 50 basis points. The dollar index rallies it rallies 10%. We get above 110 earlier this month. And so now I think we've been pulling back, and the question I think is this pullback, is this a change in trend or is it a correction? And I want to say it's a correction, but it might have a little bit more room to go. And this is really, I think, in the two drivers, I think you're right. One is on the interest rate side, and the other is on the tariff side. And in the current environment, the current mentality in the market is that tariffs are good for the US dollar, and any kind of sign of dilution, postponement, tends to see the dollar come off. And I think that's where we are now. The February 1st was talked about as recently as January 30th. And now to have it postponed, it gives it more of an impression that this is a negotiating stance, and giving another 4 weeks buys time for both Canada and Mexico to try to negotiate and to show the numbers. For example, think about why the US was threatening the tariffs on Canada. There are three reasons, I think, that Trump gave. One was because of immigration, second was because of fentanyl, and third because of the trade imbalance. And so if you just take each one of those by themselves, you would see that the people who are being picked up in the US for illegally crossing the border, about 1.5% come from Canada. And fentanyl, about 0.2% of the fentanyl that US police law enforcement confiscate in the US comes from Canada. These are two really minor issues, it seems to me, objectively speaking. And the third issue, trade balance. Yep, it's true. Canada runs a trade surplus with the US. But out of all those goods that Canada exports to the US, roughly speaking, 25 to 30% are from US companies, not Canadian companies. I mean, it's Ford, GM in Canada exporting car parts back to the US. It's not Canadian auto companies per se. So, anyways, this just gives a sense that of what's being involved. It's a very political decision. And in any event, my sense is that there's probably room for this dollar to correct lower in the days ahead. I'm looking forward next week, looking at the jobs data at the end of the week. And I think that we're going to see more signs that the US labor market is slowing. And I think that takes some pressure off the interest rates. And there, the dollar, I think I'm looking at the dollar index initially 107. But if we can take out 107, I think that we can go down to 106, maybe even a bit below there. I had been starting this like a head and shoulders pattern, this technical reversal pattern, the dollar index. And that neckline there is 107 and a quarter. We violated that and bounced back above there. I'm not sure the state of play of the pattern, but it still seems to me that the correction that began in the middle of January probably has some more room to run in the next week or so.
This is so interesting how it's all going to play out. But one comment that you made there, Mark, is that when tariffs are potentially introduced on a country, the central bank might cut rates. Take us through the thought process of why the central bank would cut rates and how it could impact the overall trade then if tariffs are in place, but then if the country who has the tariffs on them is cutting rates.
Yeah, no, I think this is like it's sort of like getting into the plumbing of this. And here's what we've seen happen with Canada, for example. We know that because Canada, out of Canada's exports, 80% of them come to the US. Different types of academic studies have suggested that if the US were to put a tariff of 25% on Canada, the Canadian economy would fall into recession. It would likely contract by something around 2.5 to 3%. So if you are sitting in the Bank of Canada's shoes and you see this economic shock, tariffs, going to be a big headwind to the economy, what would you likely do? It would likely add to the easing pressure that you might feel from the slowing economy already. So in addition to that, what we saw happen is because of the economic hit, leaving policy alone for a second, because of the economic hit that would take place when it looked like tariffs were going to go into effect on February 1st, that gave a bid to Canadian bonds. And as soon as it was announced that the tariffs would not be implemented until March 1st, Canadian bonds lost that bid. That is to say, yields rose with the idea that tariffs were less likely in the immediate future. So I think the idea is that the tariffs would, even though, of course, it's Americans, it's the importers that pay the tax on imports, but that would slow down the demand from countries like Canada, Mexico, or Europe, or China, wherever the tariffs are placed. And that slowdown, depending on how important those exports are to the economy, would be tell you sort of the magnitude, or give you a sense of the magnitude of the negative economic shock. It's not clear, though, I think to your point too, I think, Corey, that it's not clear. I know the market right now has in their mind that a tariffs, the U.S. would implement tariffs would be good for the U.S. dollar. That wasn't always the case. During Trump's first term, we didn't really see the dollar respond so much to the tariffs. Think about the aluminum and the steel, and also on China. So I wonder if that seems to be the conventional wisdom right now. The U.S. puts tariffs on a country, it's good for the dollar. But I wonder if after that sort of knee-jerk reaction, if I could say that, that maybe people focus on the negative consequences of the tariff, which is a tax on U.S. consumers, which we saw with that Q4 GDP number U.S. reported. Consumption was really, again, it was stronger than expected, and it really led the economy. And so if people like me are thinking that the economy is going to slow, we sort of think that the tariffs would, like any tax on consumption is going to slow down consumption. So maybe what ends up carrying the day is not the positive impact of the dollar, but really the slowing down of the economy that drags the dollar lower.
Well, Mark, one country we've not talked about yet, or their currency in relation to these tariffs, is Mexico. Because if we're talking about fentanyl, quite a bit more comes in from Mexico than from Canada, as well as illegal immigration. They're also supposed to be a manufacturing hub, and one of the ideas was to friendshore and have more manufacturing coming in from Mexico versus China. Look at what's happened in lieu of the fears of these tariffs to the peso. I just wanted to get your thoughts on Mexico.
Yeah, I think you're right. Mexico, if you look at those measures, Mexico, of course, is a bigger challenge for the US and Canada. But in Mexico's defense, I would say that those numbers have improved and over the last several months. It's not just the past month or 2 months since the election, but they've really been improving well into the last part of 2024. What strikes me about the peso really is how resilient it's been. The dollar's high against the peso took place before inauguration. The dollar reached almost 20.94 against the peso on January 17th. And since then, we've been going sideways, broadly sideways, and that you can see from the convergence of the 5 and 20-day moving averages. But we've been going broadly sideways, and we couldn't make a new high, despite people thinking that the tariff could be in place as early as February 1st. And even when Trump had threatened it again on January 30th, the dollar didn't make that new high. And what's even more amazing about that, Chad, is that it's not just this tariff that's hanging over the peso, but what's going to happen is next Thursday, the Bank of Mexico meets. And they've been seeing the economy, fourth quarter GDP was much weaker, bigger contraction than expected. Inflation's been easing, and it's possible that the Bank of Mexico, the central bank, cuts rates 50 basis points next Thursday. And I think the bias is they will, unless the peso is weaker than it is now. So call the peso now we're having a nice rally into the weekend where the dollar's at about 20.68 now. So as long as I think the dollar stays below 21 against the peso, that would be a little bit higher than when we saw in the middle of January. So this is to say, if the peso doesn't sell off much from here, It's a reasonable good chance that the central bank cuts rates 50 basis points at next week. So we got the tariff, and I think you have this rate divergence that are the two big factors here.
So, Mark, tying this into markets, what market segments benefit from? It sounds like a shift in narrative away from central banks where they're on their course, and many of them, I think, will be pausing or continuing to slowly cut rates. A shift of attention has gone to tariffs, which is just such a wild card because we don't know when they're going to come in and we don't know to what degree they're going to come in. But markets are continuing to do well. But to me, with the uncertainty around tariffs and central banks pausing, but still potentially going to be slowly cutting, to me, it seems like interest rate sensitive sectors, even some of the safer sectors, should do well in this environment. But where do you see the opportunity?
Yeah, I say a couple of things. One is I'm still watching closely this 450 level in the US 10-year. I think that the US rates have pulled back, but maybe they're a trough for them. I think about the quarterly refunding. So I'm want to watch the 10-year. And the other amazing thing that's happened, and this even got to be on the front page of the Financial Times, because of the fear of tariffs, it looks like there's been a big transfer of gold from Europe, Switzerland, as well as other countries in Europe, to the US. This might have contributed to the US trade deficit in December. And the reason that this isn't about gold or the dollar's place in the world economy. It is that if there's going to be a tariff on US imports, then people who are in the gold business who need to distribute it when people call on it to get the bullion, they need to bring it to the U.S. before the tariff. If there was going to be a tariff on gold imports, it would really disrupt that sector. And so I'm watching sort of how people are positioning themselves for fear of these tariffs. And I do think that the market might feel a bit confident now about that the tariffs will be postponed until March. But I think that what we found both in Trump's first term and so far even in these early days of the second term, that we have to take his threats seriously. And I do think that the tariffs is not just about trade, but remember that the underlying agenda here is also about making permanent his previous tax cuts. And to do so requires raising revenue to make it credible. And raising revenue, he likes the idea of tariffs. So I think I would take them seriously. And I do see, as you say, how well equities, not just U.S. equities, they're European equities. The Euro Stock 600 is at new record highs. We've had a strong rally in Japanese stocks in recent weeks as well. So stock markets seem to be continuing to push ahead. I thought it was instructive this past week, something we haven't talked about, DeepSeek, the Chinese AI. And I think that this is, even though the U.S. stock market, the NASDAQ gapped lower last Monday, with Friday's gains, the gap has been closed. And so I think it just raises a lot of questions and again plays on this U.S. insecurity that despite the semiconductor and other efforts to contain China, it's leapfrogging past. I came across this interesting statistic that roughly speaking, China graduates more bachelor degrees in engineers, 10 times more than the U.S. does year after year, 10 times more. And so just imagine what that's going to be like when you have the compounding of that.
A lot to take in here, Mark. Thank you very much for diving more into some of the nuances of what we're seeing or potentially could see within tariffs and central bank moves, and then how it ties into the currencies. These next couple months are going to be so interesting to see what comes in, what doesn't come in, and the volatility in the markets. I think we all understand that is going to remain because we just don't know what Trump is going to do. And he really has taken the narrative away from a lot of central banks right now with these different potential policies. So, Mark, it's great having you back on the show. Again, Marc Chandler, managing partner at Bannockburn, Global ForEx, also editor of the Mark to Market website. Mark, we'll hopefully chat with you next week. Have a great weekend.
Good luck, everybody.